Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. It is a waiting game now for investors. All eyes pointing at whether the Fed cuts rates in a matter of days. Plus, Washington is paying attention to new tariff and trade concerns. We're going to have more on those stories. And right now, this is now to go into the closing bell. Stocks, you can see there, we're mixed. The Dow's down about 184 points. S&P 500, your broad gauge, is up about 0.2%. Tech-heavy NASDAQ is up about 0.6%. Let's welcome in now Washington correspondent Ben Worschel. We've got data and markets editor Jared Blickery. Jared, we will start with you, my friend, on that trading action so far.
Yes, we are looking at a down market in the Dow, but it's a mixed market. We got some green as well. Dow's down 183 points or 0.4%. This is the intraday price action. It's not a big move, but you can see we're pretty close to the lows of the day right there. Let's take a quick look at the 5-day price action, up 1.15%. Here's the NASDAQ over this week, up 2%, and here's what it's been doing today. A different story at highs, whereas the Dow was at lows. Very interesting difference here. We're going to take a look at tech in a second. S&P 500, just barely positive, so we're not going to make too much of that price action. And then the Russell 2000, the small caps underwater, more than 0.5%. S&P 600, this is profitable small companies only, and that's down even more, almost 1%. And what's been going on in the bond market lately, we've seen a lot of moves to the upside and the downside in yields. Today, it's to the upside. We got 5 basis point move from all the way up to 4.06 in the 10-year yield. And then looking 30 years out, the 30-year T-bond yield, that's up 3 basis points to 4.68%. US dollar index just, we're going to call that break even there, not a huge move in the dollar. And if we look at the sector action, we see communication services. That is up 1%. That's number one spot, followed by utilities, consumer discretionary, and tech. All 4 of those are outperforming the S&P 500 here. What's not working today is materials, healthcare, industrials, energy, all of those down about 0.5% all the way up to 1% down. And here's the NASDAQ 100. More green than red, especially in the mega caps. The smaller ones, you're going to see a little bit more red than green. But look at Microsoft. It's up in the lower corner there, 2.27%. Broadcom up 85 basis points. Amazon down a similar amount. And then here's Tesla. Tesla's up 7%. If we take a look at the Dow, we can see also, look at all the red concentrated in some of these smaller issues. Walmart at JP Morgan, United Health, Caterpillar, little green there. But for the most part, we're seeing more red than green, as we've been discussing here. I did promise you a look into the tech industry. We're looking at semiconductors first. So this is the bright spot in tech right now. Micron, which has been on fire recently, that's up almost 5%. AMD up 2%. Lam Research and ASML each up more than 1%. But take a look at software here. It's a different story. Aside from Microsoft, look at Oracle, which had a great week, by the way. It was up, 20-30% in one day earlier this week. Not today. It's down 4%. That follows a loss yesterday. CrowdStrike, Take-Two, EA, and maybe 1 or 2 others are in the green. But for the most part, software following the pattern of what it's done lately, which is not that well. Send it back to you.
All right, meanwhile, Wall Street and Washington, then waiting for next week's FOMC meeting, plus a few pressing question marks looming. Ben, what are we watching out for?
Yeah, so what we're watching for, Josh, is a lot of drama between now and when this Federal Reserve meeting gets underway on Tuesday. That's because, as you mentioned, there's 2 big question marks in terms of actually just who's going to be around the table. The first one is Trump's pick of a top economic advisor of his to fill in a vacant seat on the Board of Governors. Right now, Stephen Myron is on track for a Senate confirmation vote Monday afternoon. That's right under the wire of the Tuesday meeting kicking off. The voting's there set to start at 3, but could go into the evening. One thing to watch there is that vote is happening alongside a pretty controversial vote in the Senate on changing the rules for lower level nominees. You're going to see a lot of political fireworks around that. The question, of course, is whether that changes the timing of this confirmation for Myron. Once he gets through that vote, he can be immediately sworn in and be seated at the table. So that's one big question mark. The other one is Fed Governor Lisa Cook. Trump, of course, is attempting to fire her. A federal judge ruled that she could stay in place while the case plays out. But Trump filed an emergency injunction decision there, or an emergency appeal there to reverse that decision. And the state of play there is that there is a paperwork deadline Sunday, which could set up a hearing as soon as Monday on that question. So those are the two big balls in the air. I think it's also worth noting that even with all this upheaval, there isn't a lot of drama, at the moment at least, around what the Fed will do when it has its interest rate decision. I just checked the traders a little bit ago, and there's no chance of a Fed staying steady, and a 95% chance of a quarter point basis cut, and then a 5% chance of a jumbo 50 basis point cut. So the focus here is a lot of drama on kind of how the day looks, what input Trump has on the deliberations, but a little less drama on exactly what the decision is going to be on Wednesday.
And switching gears a bit, Ben, while we have you, we're learning that the U.S. and China coming back to the table, hammer out trade tensions, other thorny issues this weekend. What's the latest there?
Yeah, so what we're going to have is a fourth round of face-to-face talks with Treasury Secretary Scott Bessent starting on Sunday and going for a few days. So that'll be something to watch early in the week. These talks are going to take place in Madrid between Bessent and his Chinese counterpart, and a couple deadlines to watch there on the economic front. The first one is TikTok, because TikTok, the formal deadline for the app to be sold is coming next week, on the 17th. Trump has already said he's likely to extend it, but both sides have said that's going to be a big issue in these talks. The other one, of course, is tariffs. The deadline for a snapback to reciprocal tariffs isn't until November, so there's about 60 more days there. But the focus on Russian oil and punishing India and potentially China for its purchases of Russian oil could give both sides a lot to talk about there. Another important aspect I've been looking at today is the focus on a meeting between President Trump and Xi Jinping. There's a lot of sense that the end of next month, the end of October, at a summit in South Korea could be the time when the two men get together and have their first face-to-face meeting since Trump was re-inaugurated. But we don't have any confirmation of that. So I think a lot of folks are going to be looking for that as a sign of at least a little bit of a thaw between U.S.-Chinese relations, if they can get this meeting on the books, which we've been waiting for weeks and weeks now.
All right, Ben, Jared, thank you guys both. Appreciate it. We're here with more on the path for monetary policy and what it means for markets. Let's welcome in now Infrastructure Capital Advisors CEO Jay Hatfield. Jay, it is great to see you. So, big Fed meeting on deck. We expect the cut. We know what the president thinks. He thinks it should have already been cutting, right? Too late, pal. In fact, Jay, the president, my friend, he quotes you on True. So I saw this. He quotes you saying Powell was late to raise rates. So the president of the United States, leader of the free world, Jay, he's listening to you and taking notes. How did that feel?
Well, that was, I thought, pretty funny, because he also quoted our comment that not believing in the money supply is like the Pope not believing in Jesus. So he put in even funny thing. And also he adds things, because I didn't call him too late either. I've said worse things than that, but I don't call him too late. But we've been critical of
There it is. There's the post.
Yeah. But we've been critical for 4 years, so it's not like we're not just doing this like a momentum political trade. The Fed is...
Why are they too late, Jay, in your opinion?
Well, they have three terrible fundamental flaws. First is the 2% target is way too strict. They just completely made that up. Should be 2 to 3.
It should be a range.
A range, of course, because, partly for the second reason, which is they use an index that's 2 years behind. So the shelter component has the owner's equivalent rent that's both, they purposely delay it 6 months. So it's just by law delayed 6 months. And then because they use renewing rents and this weird panel like they do for the labor statistics, it's behind. So that's terrible. And so they're really just, and then finally the Pope comment, they ignore the money supply. So they're terrible forecasters of inflation. Most notably in early 21, we were projecting double digits and they were saying transitory because the money supply was up 70%. You can't do that. If you could do that, then we wouldn't have to have taxes. You just increase the money supply. But of course they do that in Argentina and Venezuela, and they have 200% inflation. So they're really, really bad at their job, and that's why we're not as focused on independence as we are on incompetence and getting a new regime in there to effectively execute monetary policy, because most Americans don't understand that's the most critical thing. If you blow that, like you get the great financial crisis, you get the great inflation of 22, So it is the most important thing that drives the stock market. Everybody should be watching it. You should watch the money supply every Thursday when it comes out.
Let me ask you, as someone who wants to cut, a natural question often brought up on this show is, walk me through what you think the risk is of cutting if inflation is above their target.
Well, we don't think it is above the target, so we publish CPI-R, so that uses this thing called the internet, which was developed this century. The BLS used something that was developed last century called a survey that nobody responds to anymore. So we believe our index is way more accurate. It says CPI's 1.7% year over year and PCE core.
So you would not be in the camp, Jay, of the economists coming on here and say, just wait, that tariff inflation spiral is on the way?
Well, even for another reason, because they're in our opinion, misanalyzing tariffs. They should be analyzed like a sales tax. So just think of an example. They had 100% sales tax. Would that be inflationary or deflationary? Well, it's clearly deflationary because you're sucking all that demand out of the market. And then in 1 year, you'll anniversary all those price increases. This Fed is worried about expectations. We don't think that's important for predicting inflation. Again, the money supply and oil prices are important. So we are 100% in disagreement with that kind of establishment view and believe Waller has it right. That's why we're really
Is Waller your guy?
He is, yes.
He is.
Way more than Warsh because he was involved in the great financial crisis. He raised rates 17 times in a row right before the great financial crisis, which precipitated the great financial crisis. So he's very hawkish. He was even hawkish while it was going on.
There's been some reporting that Waller is in pole position here. You've seen that.
That would be fantastic. He is a monetarist, so it would be like having a pope that believes in Jesus. So it would really be fantastic. And then, by the way, I would be all in favor of having independence as long as you have a competent Fed chair.
Can I ask you, since we're talking about tariffs, you're a free market guy. Do you like tariffs? Do you think it's a smart policy tool?
Well, we also are non-consensus on that. We do think so because it's really the only way that we can get any kind of fiscal discipline as well. I was at a dinner with a senator and we were lamenting that you can't pass anything that has fiscal discipline. Can't cut spending or increase taxes. Well, the president apparently, at least for now, has the authority to do this unilaterally. It's unpopular, universally really unpopular. But we're forecasting the budget deficit goes down to 1.3 trillion from 1.9, 350 billion of revenue from tariffs. And a lot of it is borne, not all of it, but a lot of it's borne by the exporters and some companies in the US. So it's pretty well distributed, great way to raise revenue. It's better to tax consumption than investment. It's good for growth. We estimate long-term growth, the US economy could go up by 0.2, which doesn't sound like a lot, but the compounding of that when you have 30 trillion gets to be a really big number in the long run. So we hope that those tariffs do stay in place.
And yet, well, I'll get you out of here with this, the Trump tariffs now, I mean, the future uncertain. Let's say the Supreme Court, Jay, weighs in and says, you know what, it's illegal. I'm curious how you think that markets could react, because I could see a situation which maybe the stock market thinks, well, hey, that's great. I don't have all the margin pressure. I don't have to worry about it. But I wonder if the bond market says, well, whoa, all that revenue coming into Uncle Sam's coffers we were counting on, you're saying we can't count on. I'm curious how you think the financial markets will respond to that kind of decision.
It would be, in this market, good examples today, like it just doesn't want to go down. So it'll go up if tariffs get cut, if they get increased. But on the bond side, we think the key driver is really the Fed. So if you look at the terminal rate, expected terminal rate on the Fed funds, the 10-year's tracking 100%, 100 basis points over. So everybody is afraid of like, oh, the inflation expectations and a budget deficit. It's really driven by Fed policy, but it's a minor negative, and we think it would be bad for long-term US growth and slight headwind rather for bond prices and higher yields.
Jay, always great to see you, especially on set.
Great, thanks Josh, thanks for having me on.
We are just getting started here on Market Domination. Coming right up, what is the secret sauce to a true turnaround success story? We're digging into the topic and exploring the right catalyst for stronger corporations. Plus, what do Marine One and Joby have in common? We're sharing some news with you from the White House. And sometimes the stock market is a roller coaster, but on Friday, one ticker was climbing high. Those stories and a whole lot more coming right up. Stick with us. Jay, that was great. Opendoor has become one of Wall Street's most talked about stocks. Shares soaring nearly 80% in a single day after naming a former Shopify executive as CEO. Stock is now up more than 400% this year, and our next guest has confidence that this isn't just another meme stock, it's a real turnaround story. Joining me now, got Eric Jackson, founder and president of EMJ Capital. Eric, it is great to see you on set. So let's talk all things Opendoor, Eric. You have a new CEO. Co-founders coming back to the board, some big names there. Walk me through what this means. And I'm curious, Eric, just how you think about what the business strategy is going to be here and how Opendoor, in your opinion, succeeds with just the brand, the tech, the platform they have now.
Well, Keith Rabois has been the most outspoken guy on Twitter, like up to this point, out of any of them, in terms of sharing his thoughts. He never holds back. Like he has no filter. Just like what he thinks he says. He's very was very critical of Carrie, the former CEO. Said she was like a Scully. And needed to be gone as ASAP. He was right, by the way. And so I tend to think my personal belief is like he's the smartest guy in tech, in bar none. Okay, I agree with Keith. He's not always 100% right. None of us is, but he tends to be very, very right and very on the money and knows how to create value. So he's already hinted like there needs to be major job cuts here. There needs to be like a focus on AI. There needs to be an explosion of the number of sellers and buyers like on Opendoor transacting. And this can be the Amazon of housing if they get this right. Now it's been kind of validated, that view, because obviously he's back on the board now. He had a major hand in hiring Kaz, the new CEO. Keith thinks that Kaz is going to be like the Travis Kalanick in terms of how he goes about this. There's apparently been a big like work from home ethos at Opendoor. That's gone. Everybody's going to be in the office now. Keith said this company could survive with like 10% of the current workforce, and the rest done through AI.
How big is that workforce right now?
1,407 people currently, according to Bloomberg. So he's talking about going down to like 100-person, 150-person workforce. Probably, so it would be a major difference. So the bearish case against Opendoor before Keith announced the 80% update yesterday, and Keith and Kaz coming back was like, iBuying's never worked, therefore it will never work. And this company has failed before. It's a little dinky company, $3 billion market cap or whatever. Like why, it won't be successul. So mind you, like that argument would have said that when Steve Jobs came back to Apple, just shut it down then. There's no point in continuing because it hasn't been successful to this point.
Which some did say, by the way.
Michael Dell did say that.
Yep.
So anyway, but then you say like, why would the number 2 guy at Shopify, who probably if he played his cards right would be the CEO relatively soon, widely respected in the world of tech, everyone loves him. Why do we leave Shopify and take the job as CEO of a before the 80% update was probably a $2 billion, market cap company. Mm-hmm. Like, obviously, like he sees the same vision that Keith does, and he thinks that this can be the Amazon of housing. First in the US, but then like the Uber playbook is you blow that out worldwide, international. So, obviously he sees this as a big opportunity, and I agree with him. And so, the bears really don't have a leg to stand on now.
Let me ask you this. I was talking to an analyst who covers the name this morning. He brought just a question up, which I want to ping off you. He said, how, in his opinion, the model sort of changed in Opendoor, meaning they began to really kind of meaningfully integrate real estate agents. Whereas the original mission, his point was, hey, much more just direct buying and selling with the consumer, leave the agent out. Mm-hmm. And I'm just curious, how does that sort of change the value proposition? And is it still so different, Eric, from a traditional brokerage if you're doing that?
I think if Keith was here, he'd say, no, it's not different, Josh, and that's why we got to get rid of it, the agent relationship. Mm-hmm. So he's very kind of like, Keith is very much like, we got to blow it up, and we got to do, a lot of people just don't want to pay 6% commission rates to agents. And so we should be building a platform that deals directly. So again, like the truth is iBuying is a low gross margin business. That's true, yes. But in Carvana's world, buying and selling used cars, they make almost no profit from buying and selling of the cars. They make something like 80+% of their profit from finance and interest. And I think the view of Keith and the kind of the new regime will be like, like, hey, we can make some money here, not just iBuying on its own, but iBuying with mortgage and title, and with AI and like dramatically reducing the workforce here, we can make some money here, and we can have a disruptive model that doesn't need to use the agents. I don't think they'll do that right away, though. If there's a way of like playing nice with the agents, maybe in the next few years as they transition, they'll probably take that money and take that opportunity. But I have no doubt that they have this like longer term view of like we got to blow this up, just like Uber blew up taxis.
One question I got from an analyst was, he says he's hearing from his clients. You mentioned Keith. One question they get is, how do they actually get Keith to come back? And just so viewers understand, Keith Rabois, big name. I mean, that is a very well-known, well-respected, wildly successful venture investor. What were those conversations like to get him back?
Like between me and Keith?
Yeah.
Well, I had this meeting yesterday with a guy who's like a CEO of a private company that Keith's backed. And he was like, man, great job on Opendoor. And I was like, thanks a lot. And he said, like the funny thing is I had a coffee with Keith in June. And I was like, wait, what's going on with Opendoor? And Keith was like, I don't know, man. Like those guys, like they're hopeless. This thing's like circling the drain, and that's like less than 3 months ago. And like, so we went from like him believing like this thing, and it was circling the drain. I mean, this was 51 cent a share stock price on June 25th. And so I, along with the Open Army, we sort of like said like, hey, there's more value here. We breathed life into it. I think it got Keith energized. I started communicating him after like he was seeing like, hey, something's going on here. And we would have these like very cryptic like exchanges on DM or email. I didn't actually meet him until a week ago here in Soho. And he is just as brilliant as I thought. I was like way more excited after hearing like his vision and some of his ideas, which are now going to be put into place. And so I just think he got energized. And that's what this guy, the CEO, told me is like, man, he's all in now, and now he's tweeting out stock price charts and stuff, and I've never seen Keith do that before. And so he was on CNBC earlier today, I believe. I haven't had a chance to see it yet, but he's a brilliant guy, and like the company and shareholders are so lucky to have him and his full force and intellect and energy behind this. Big name to get back in. Eric, thanks so much. Appreciate it. Now time for some of today's trending tickers. EMJ Capital, Eric Jackson, still with me. We're going to take a look at Joby, Constellation Brands, get Eric's thought on Six Flags. We'll start with Joby. Company announcing it is planning to participate in the White House eVTOL integration pilot program. So this one, Eric, all right, so Joby Aviation, it was on the move. It sounds like it plans to participate in this White House pilot program for those companies who are involved in this broader electric vertical takeoff and landing space. We did talk about it earlier this week because there was some Uber news as well. Uber customers are going to be able, I guess, to book Blades services directly within the Uber app as early as next year. Joby's up around 70% this year. What do you make of this name? I like this name. Actually, I wasn't involved in the de-SPACing event, but like very soon after Joby came public, like in 21 or something like that, and I was like an early Joby believer. This was brought public by Why were you an early believer? Mark Pincus brought this thing public, and so it's similar to Opendoor in the sense like there were a lot of like names that came out as SPACs, and then we said, we hate SPACs, all SPACs are bad, and all this kind of, and they all dropped and they all got forgotten about. But like I think the vision of Mark Pincus and his company reInvent, who was behind this, was like right on the money. Like, it was thinking ahead, a few years ahead, but we are a few years ahead now. And now this thing is, you can see that this wasn't just a pipe dream. Like Joby's a company that has like a major partnership with Toyota, and they've now Blade, and they're doing all kinds of things together. I mean, and now serious people are really saying we will be transported by these like autonomous, drones, in the very near future. And so when you start to do the math and you start to build up, your models of like how big a business it could be, it's still, it's potentially massive compared to like the current stock price. So I don't own it right now, but it's a blast from the past for sure. And definitely these SPACs are often like great places to troll and find these like Walking Dead type companies that people just have like walked away from and forgotten about. And then you start to look under the covers and you say, hey, there's a real business here. Well, I get to another name, get your thoughts on this. Beer, wine, and spirit
spirit companies, Eric. So Constellation Brands, Molson Coors getting hit with downgrades at Barclays from lowering its rating on Constellation Brands from overweight to equal weight, so they moved to the sidelines, lowering Molson Coors from equal weight to underweight, so the equivalent of a sell there. Here's what the analyst says. We struggle to think of a positive catalyst for U.S. beer trends. We know there has been this decline in consumption, Eric. It sounds like particularly among young folks. Analysts at Bloomberg also weighed in. They say we expect the U.S. alcoholic beverage market to remain stressed. They talk about consumer frugality. They talk about rising uptake of legal cannabis, BC drugs. They point out a lot of headwinds. What do you think?
I come from the generation. I'm like Gen X, Josh. I'm older than you, I think, but we used to like our drinks, and I still like to have a good drink. I like vodka, tequila, white wine, red wine. Yeah. I'll be honest. I stopped drinking beer a while ago because of my waistline. We started getting bigger and bigger, and that's it doesn't take a rocket scientist to figure out you're not going to go very far with beer. So, but I've been shocked at seeing some of these surveys of young people, like you say.
For sure, Gallup had a really interesting one.
Nobody's drinking anymore. It almost makes me a little worried for the younger generation. I mean, you got to have some fun, but beer is definitely on the way out, and I see it with my own kids. My kids are all into creatine and working out and all this stuff, and they think beer is passé. So
youth wasted on the young, right? What are you going to do?
Not great for Constellation.
All right. Lastly, let's take a look at Six Flags. I want Eric's take on this too. Wall Street liking what they heard from the company about its update on attendance trends for the summer season. So this one, Eric, will end here. Obviously, the theme park operator reiterated full-year adjusted EBITDA guidance. Citi has a buy on this one. They were saying that August trends, sharp contrast, the disappointing July year-to-date results. Stock, this has been rough. We're down about 50% so far this year. What do you think?
I think people still like experiences.
Yeah.
I think that they want to do go out and have fun with their friends and stuff. And these names and Six Flags, I mean, they have an experience that kids, again, young people, just still want to do stuff in the summer and have some fun, and this is a way to do it. So they're not going to face competition in the near term. I guess their competition could be sleep and Netflix and all this kind of stuff. But people want to get up and get out and do something that's interesting. So I think it's interesting.
Yeah, sleep and Netflix sounds great. Eric, it was great to have you outside. Thank you, sir.
Thank you.
Coming up, Wall Street back when it comes to new IPOs. We're digging into what's working so well for companies to continue going public here. Another day, another IPO. Crypto exchange Gemini Space Station joining in on a slew of companies going public today, but it's not just today. It's been a busy week with IPOs with companies such as Figure Technology and Klarna also making their public debuts earlier in the week. For a closer look on the action, let's get to Yahoo Finance's Jared Blickery. Jared.
Thank you, Josh. A whole slew here. This is what's happened this week, and I'm not even including the pre-SPACs, those public acquisition companies that are trying to go public here. Here's Gemini. It's up 17%, and that is a pop from the IPO price, and I'm going to dig into that in a second. But at first, I just wanted to go through the list here. This is how much money has been raised by each of these IPOs. Klarna, by far and away, that is the biggest at $1.37 billion raised. That's not the size of the company. That's how much money they raised at their IPO. Then you have Zenta, very small, $6 million. That's a fintech, very similar to Klarna in that it is fintech. And then you have Figure, that's blockchain plus fintech. They raised $787 million or thereabouts. LB Pharmaceuticals, as you might guess, that is a pharmaceutical play in the biotech space. And then we got BlackRock Coffee Bar. That is a pure consumer discretionary play. That's retail, raised $425 million. And then $294 to Gemini. That's a crypto and a little bit more fintech there. And then finally, Via Transportation. I guess I would call that transportation tech, and they raised almost $500 million right there, $492.9 million. And if you take a look at the opening day pops here, and I do have a little bit of issue with some of this, and the reason that this has become the benchmark, but then this is in fact one of the benchmarks that Wall Street uses to gauge how hot the IPO was. So you take the IPO price, which is set the night before the stock stock actually begins trading. That's where all the insiders get into the stock, and then you measure the opening price the next day, and usually that's sometime between 11 a.m. and 1 p.m., sometimes even a little bit later. You're going to notice there's kind of a sweet spot here right around 30%. And so a lot of these pops kind of settle in that area. You got Klarna 30 exactly, BlackRock Coffee Bar, Gemini Space, a little bit north of that. Figure was a big standout yesterday of 44%. And then Via Transportation opened a little bit under its IPO price, though I should say it's trading above it right now. And that's really what I'm talking about here, is that it matters where you close the day from the relative to the open, because most people are not going to get at that insider's price, which is the IPO price. They're going to get at sometime either on the open or after that, and then they're going to make that money into the close, or they're going to lose money into the close. So next week we'll be able to kind of filter out and see which one of these was actually profitable for investors. But in the meantime, I just wanted to show you a chart here of US IPO deal value by quarter. This goes back a whole decade, and so you'll see this huge peak in the middle. I showed this yesterday. That's 2021. That's the era of free money when we had all that fiscal and monetary stimulus. And you're going to see there was a huge crash. We had a bear market in 2022. Fed was aggressively raising rates. Cost of money went way up. And so we crashed. But now we've just been kind of stair-stepping higher. And we are kind of almost back to the pre-IPO era. And things have definitely heated up here, and it's catching a lot of eyebrows. But I would issue this little word of caution. Before you jump into a new IPO, consider this stat. 90% of all IPOs undercut their first day of trading price within the first year. And so you usually get a pretty good opportunity to get into these IPOs at lower prices than you see in those opening days. Now I'll send it back to you on that.
All right, thank you, Jared. Well, what once started as simple chatbots and recommendation engines has now become a powerhouse in financial markets and the economy. That very thing is no other than artificial intelligence, of course. Trader Talk host Kenny Polcari sat down with Futurum CEO Daniel Newman on the growth of AI that has become comparable to the Industrial Revolution.
With each transformative era, and you've been through it because you watched the markets revolutionize, right? And I mean, think of how much trading now is algorithmic, right? There used to be, used to be paper.
Oh, trust me, I was one of those guys.
Right, you were there.
Look, I'm a boomer, so I was one of those guys.
Hey, boomer. But you know that this stuff is changing very, very quickly. Yes. Now, in every revolution of the past, it's been about more jobs, not less, right? And so you go through the industrial revolutions, you went through, the printing press, you went through radio, television, social, mobile, all these things, more jobs were created. But I'm more cautious this time. And the reason I'm more cautious, you kind of said this in the introduction to this show, is these agents and this technology and how much it is capable of doing. I've never seen technology kind of more directly come after both white collar work and blue collar work at the same time so quickly.
Right, and I think that's the concern for a lot of people, right? Because they don't necessarily know, it goes after blue collar work, that's kind of what it's always done. But now it's coming after white collar work. And so, and across the spectrum, could be legal, could be analysis, could be so many things.
Yeah, but you think about over the last 5 years, 10 years, the gig economy. This is a really interesting thing that I've been thinking a lot about. The gig economy created jobs, delivering food, delivering people. Uber, it's been amazing. But now Tesla's building robo-taxis.
Right.
And I'm in Austin. They're driving around my city right now, Waymo. Right. This is great technology. And by the way, more reliable than humans.
Yeah, but do you get in a Waymo?
Absolutely.
Do you?
Absolutely. Don't even think twice about it. Look, the Waymo drives much better than the average Uber driver. It's a data-driven fact. I'm a data-driven guy.
Right.
But the bottom line is do you care if DoorDash would be delivered to you by a drone, or by Optimus robot, or Right, we don't. But the thing is, think of how many people created a gig during the gig economy. Now, either they couldn't make enough money in their first job and they now are driving Uber. What happens now when all that gets replaced? That's just one example, though, of potential replacement, disruption, displacement. So what we see overall is that time is the biggest issue here. Because what I do believe fundamentally, as a techno-optimist, what I do fundamentally believe is that the revolution of AI will create a boom. We think $30 trillion of economic growth, Kenny.
Right. Yeah.
But historically, the transformations have been over years, maybe 5 years, 10 years. This has happened so quickly.
Right. This is not happening over that period of time. It's happening much quicker. And I think that's what can be so overwhelming to people, right? So when you think about it, you think about the birth of AI. When would you actually When would you actually pinpoint the birth of AI?
I mean, there's a lot of debate, but there were, universities and academics back in the 1950s were talking about AI. Algorithms were started to be played with 40 years ago.
Yep.
So the idea of AI being something new, it's not. It's been around a long time. But in
It's new to the mainstream.
Well, yeah. I mean, look, a lot of us have been sort of doing things that were AI-ish for some time,
Right.
not really realizing it. Like voice-to-text translation, like how long we've been able to do that on our devices. We didn't think twice about it. If you've been using Google applications for a long time, Google was kind of starting to finish your sentences. It's been several years that this
Right.
kind of technology existed.
Right.
Netflix, the ability for it to recommend to you. So these are all things that are kind of considered ML, machine learning, considered advanced analytics, the ability for it to say, oh my gosh, you like this movie or you like this coffee, you want some, this is all AI.
Right.
But obviously now what we're seeing is instead of it kind of maybe recommending something to you or filtering a result in a Google search to get you the right thing, now it's actually creating stuff for you. And to your point about agents, Kenny, it's not only creating stuff, it can execute stuff. You can say, look, create this document, then post it on my social.
Right.
That's a simple example.
Well, no, it's a simple example, but it's very real because what I find is that ChatGPT, as you use it more, it really gets to understand who I am. It understands my voice. It understands the way I talk, how I write my sentences, how I use my language, right? Maybe different how you use yours, but it understands me, which is a little bit unnerving.
By the way, it not only does it understand you, you can actually tell it. You can tell ChatGPT, for instance, to say, actually remember this about me. And
Right.
it will remember it. You say, remember the way I write this. Or when you get to an end and you're like, hey, this create, because we're doing a lot of our research with AI, and I'll talk to you more about that as you see it. But you can get to a result, Kenny, where it's like, this reads just like me. And then you could say, remember this.
So let's talk about, we started with AI, which was very elementary. Apparently, it feels, at least now, elementary, right? Now we're talking about agentic AI. Now we're going to make this next leap into quantum computing, right? Like we started out, IonQ, which is having their investor day here at the New York Stock Exchange today, and is listed here at the New York Stock Exchange, is in that space, on the cutting edge of quantum computing.
Yeah.
Talk to the audience about what that means.
Well, again, quantum is a leap, not just the show boomer.
Yeah, right.
Sorry, but quantum is going to be this next really powerful wave of capabilities. It's going to kind of work in parallel.
Right.
And that's what a lot of people don't understand. It's not like AI is going to go away and quantum is going to enter the space. Quantum
Right.
is going to be additive. And by the way, quantum isn't all one thing. You can have quantum networking, which
Right.
we talk a lot about crypto, for
Yep.
instance. Right now, one of the biggest risks in the world to our monetary and financial systems is the fact that quantum cryptography quantum technology could break cryptography. It could break the security, RSA security that's used to secure blockchains, secure Bitcoin.
Right.
And that could happen in just a few years. The Department of War is looking into this. One of the things that was presented today at this IonQ event was that is a big concern. So quantum security can actually help prevent that. So that's one really important use case.
Coming up, there's a growing demand for digital assets. We're talking with an expert on how far crypto may go. The mix ahead of the closing bell, and now all eyes are looking at the Fed as it prepares for its two-day FOMC meeting on Tuesday. Joining us now for more, we got senior markets reporter Inez Ferre with the Yahoo Finance Playbook. Inez.
Hey, Josh, and strategists are expecting a 25 basis point cut next week. Not so much a 50 basis point cut, and that is because of the inflation print that we got this week, with strategists noting that you still had some areas of inflation that remain sticky, particularly the services sector. Also, the jobs data came in weak, and that's why they are expecting that 25 basis point cut. You had 911,000 fewer jobs in that one-year revision that came out that's ending in March. Also, jobless claims jumped up, those weekly jobless claims jumping up by the most since October 2021. And that's part of the reason, really, why the markets have been posting all-time highs, according to these strategists, because the Fed will be forced to cut rates next week, but not because we are seeing great progress on inflation, but more so because of the weaker labor market. Having said that, they're also saying you're not seeing the bottom coming out of the economy. You still have Wall Street that is relatively bullish when it comes to this bull run that we've had with stocks, particularly going into 2026. I mean, right now we are seeing the markets at all-time highs, depending on which Wall Street strategies you are paying attention to. You are seeing different price targets for the end of the year for the S&P 500. There you see some of them on your screen. But between rate cuts, and by the way, the market is anticipating about 65 or 75% probability that we will have 3 rate cuts this year. Between those rate cuts and the impact from the Trump tax incentives that were passed this year, that should extend the bull run into 2026.
Thank you, Inez. Appreciate it.
Thank you, Josh.
IPOs getting some love on Wall Street, including the debut for crypto brokerage firm Gemini Space Station. While cryptocurrencies are set for weekly gains, investors are awaiting the Fed's September meeting next week when the central bank is expected to cut interest rates. For more on the crypto landscape, let's get to Bitwise Head of Research, Ryan Rasmussen. Ryan, it is great to see you. Maybe start big picture, Ryan. You look at Bitcoin here, we're at around 116. Since we broke the records over the summer, Ryan, we kind of been moving sideways here, and I'm curious what you make of that. I've heard, some folks talk about it's Bitcoin dollars moving out of Bitcoin and into other coins, but what do you make of it?
Look, I think we have the general seasonality in Bitcoin that exists across other markets like equity markets and other risk asset markets. And so the summer is slow. The saying sell in May and go away isn't unique to stocks. It exists in crypto. So I think that's one reason why, after reaching new all-time highs a few months ago, we've chopped somewhat sideways. I think it's important to zoom out and look at the performance year to date, which has been extremely strong. And I think we're right around the corner for a heat up in the markets come Q4.
And when you say heat up, Ryan, what could we be looking at there?
Look, our target price for Bitcoin at the end of this year is 200,000, which I know is significantly higher than it is today, but we see a lot of demand driving Bitcoin to that price, particularly in Q4 as rate cuts do come in, as advisors, institutional investors look at their Bloomberg screens and think about what kind of assets they want to trade and pile into in a lower rate environment. Bitcoin is just one of those assets that looks extremely attractive right now. We know at Bitwise from speaking with financial advisors and hedge fund managers and RIAs every single day that they're more and more interested in getting exposure to Bitcoin. The ETFs make it easier to do that. And the amount of demand coming into Bitcoin is just simply so much more than supply that we believe the price could snap up to that 200K range in a very short matter of time.
You mentioned those Fed cuts, Ryan. So, you do have that Fed meeting on deck next week. The expectation is they cut by 25. Let's say they do, Ryan. I'm just curious, how do you think Bitcoin would respond and react to that?
I think Bitcoin and all risk assets respond extremely well to that. There's an element of these rate cuts that certainly is priced in. I think the market anticipates at least 25, probably 50 basis points worth of cuts by the end of the year. But what I don't think is that people understand just how quickly Bitcoin moves in risk on environments while rates are being cut. Historically, Bitcoin has performed remarkably well in low interest rate environments. I think one thing that's incredible to see is that Bitcoin has notched new all-time highs over the past year and a half, despite interest rates being relatively high for its 15-year existence. So I think we'll finally get a chance to see, now that Bitcoin has started to enter its institutional era with ETFs and with corporations purchasing Bitcoin and with governments and pensions and endowments getting into Bitcoin, now we'll finally get to see what impact that has in a low rate environment.
You highlighted ETFs there, Ryan. What have ETF flows been looking like?
They've slowed down over the summer with that seasonality decline, as I mentioned, but overall, we've seen tens of billions of dollars pile into these ETFs this year. Since launch, it's been significantly higher. For context, these were the most successful ETF launches of all time, which launched back in January of 2024 and gathered more than 35 billion in their first year, which is almost 10 times more than any other ETF launch in terms of year one flows. And those flows accelerated into 2025 We believe they'll pick back up this year as more and more institutional investors begin to allocate to Bitcoin or ladder up their existing allocations into Bitcoin. So we see flows surpassing last year's 35 billion by the end of this year and being even higher next year in the same way they are for many new ETPs when they launch.
Ryan, I heard the Winklevoss twins giving an interview today. Gemini, of course, making his public debut, and they were saying Bitcoin long term, they said 10x from here, Ryan. I am just wondering, as you look out long term, does that kind of forecast make sense to you? And what are the variables, the factors that would depend on?
Well, a 10x from here would put us at about 1.1 million. We just published our long-term capital market assumptions for Bitcoin last week, which looks out 10 years from now at all kinds of factors influencing the Bitcoin market. And we actually landed at a $1.3 million Bitcoin price in our base case. So we believe that 1.1 million, 1.3 million, perhaps higher is certainly possible in the next decade. There's a number of things driving that, but I think the real thing that's driving it is institutional adoption. And we see more and more institutional investors coming into the space and looking at Bitcoin as a hedge against the fact that you don't know what the Fed's going to do. You can't trust the BLS. You don't really know what the government's going to do. And in order to hedge against situations like that, you need hard assets like gold, like Bitcoin. So we believe that the macro environment, falling dollar dominance and U.S. dominance globally, lower interest rate environments, more demand for hard assets, and more access to Bitcoin through ETFs and other vehicles is what's going to drive Bitcoin higher. So 1.3 million is actually our 10-year forecast. I think importantly, we believe correlations will also remain relatively low over that time to other assets, which is extremely important for portfolio managers and institutional allocators. And we see volatility falling down around 30% over the next decade, which is significantly lower than where it is today and where it has been for the past 10 years. And again, that's extremely important for institutional investors.
Ryan, great to have you on the show today. Thanks so much for your time and have a good weekend.
Thank you.
While we are wrapping up today's Market Domination, don't go anywhere. We got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.